In this video, traders, we're going to look at potential option trade strategies if you're bullish on crude oil. Stay tuned. Hey guys, warm welcome to you. So as I am filming this video, crude oil has taken a bit of a dive, but this has a use whenever you are watching this, because this is an example of potentially option trading strategies you could use if you were bullish on crude oil with real world prices based on current prices and stuff, so you can kind of work it out for where you are currently in the market. So I've done another video, we'll talk about bearish strategies. Now we're looking at bullish strategies. The easiest thing, in my opinion, if you want to trade crude oil through options, is to trade using the USO ETF. That is the fund which basically tracks the price of crude oil, give or take. It's close enough for our purposes. And the easy thing with that is, because it trades almost like a stock, is that it's easy for us to kind of trade on options. There's loads of liquidity, loads of funds use it. If you're trading actual options on the futures contracts, there's different sizing issues, there's different expiries on the contracts for the futures and for the options. In my opinion, it can get a little bit unnecessarily messy when you can get exactly the same exposure you need trading USO. So the current price of USO, as I'm filming this, is around $11. It's actually $10.73, but $11, let's call it $11. So you can see the reference and benchmark for all this kind of stuff we're going to look at in a second. And let's say, for example, our thesis is that we're going to get a big, strong move, and we're going to move up to $14 by January the 18th. That happens to be the expiry of a specific options contract. There's other expiries, but I'm just picking that one because we've got to pick something. All right, so it's been there before, it's moved back down again. It's not a kind of way out of the league move, but it's a reasonable move. And so how could we do this? Now, obviously we could buy crude oil futures, we could buy USO ETF. What about in the options world? What could we do? Well, we've got a few options. I always say that and always go no pun intended. We've got a few different ways we could do this. We could buy a call option. Standard one, just to remind you guys, a call option is the right but not the obligation to buy something at a certain price at a certain point in time in the future. So let's say, for example, we want to buy a $14 call option. We think it's going to $14. We're happy to buy that $14 call. That gives us the right but not the obligation to buy USO at $14 on January the 18th, 2019. As I'm doing this video, could be whatever numbers you put in there. So the price of that is just 6 cents. So what would happen if we got to 14th? Now, we're a little bit skewed here with our hypothesis and thesis, because if we think it's just going to $14 by January 18th, that wouldn't be a very good option for us to buy, because if it expired, or if it hit $14 by January 18th, what would be the value of the $14 call option? Zero, because the right to buy something at zero, the right to buy something at 14 that's currently trading at 14 is worthless. It's a contract. You just paid 6 cents for that, you're going to lose that 6 cents. So really, you'd probably, if you were going to buy the $14 call, you'd want to see it 14 before then, so this has got some value. Or your thesis is, well, you know what, perhaps it's a resistance level, we're going to break through, maybe we're going to go to 14, 15, maybe we're going to go to 15, in which case this would be far more beneficial to you. So let's use that as a hypothetical example. Let's say we thought it was going to go to $15, so we bought the 14 call at 6 cents on the January the 18th, 2019, it goes to $15. What's the value of our call option? The value of our call option is now $1. Okay, and we've only paid 6 cents for it, so we've made a whopping 94 cents on that contract if it should go to $15. Let's have a look and see what the price of the $13 call is, because that might be a better trade. If our thesis is to hit $14, let's see what a $13 call is. So the $13 call is 14 cents. Okay, just checked, and it's currently trading at 14 cents. So it's quite significantly more, which kind of makes you think that actually that's way more likely. Well, obviously it is way more likely, but you can see how the option price changes as we go up. So let's say now we do hit $14, which is our thesis. Let's say you think 15 is a little bit too much. And you can kind of see, you know, when you work out a risk reward, the fact that you put in 6 cents to get out $1, you can see how unlikely the option market thinks this is. But if you look at a 13 call, all right, if it goes to 14, we're going to obviously make $1 on that. because it's 13, the right to buy something at 13 that's currently 14 is worth $1. We've paid 14 cents for that, but we're still making 86 cents, which is decent risk reward. It's not quite as nice as that one, but it's still nice. So it's 86 cents profit on that one. If we're buying the call option, and what were we, 94 cents profit on that one if we're using that, the $15. Don't forget we're using the $15 there. So that's probably a good way to do it. But don't forget, the problem we have with this is that the market is currently trading at 11. Well, it's just under, it's 10.73. Let's call it 11. We have to have, the price has to go to $13.14 before we start to make any money. So it's still got to move a fair chunk before we get going. So it's a reasonable bullish thesis that is like quite a precise bullish thesis. If it goes to $12, you know, the call option expires worthless. The right to buy something at $12, sorry, the right to buy something at $13 that's currently $12, there's no value. So we've got to be mindful of that our break-even point is much higher when buying a call option that's perhaps way out of the money to the high side. If we buy a call option kind of at the money, it would be, you know, a lot more expensive, but then again, you know, we're going to get the payoff straight away. So it's kind of a swings and roundabouts, but that's the kind of thing that you would do if you really were extremely bullish and you wanted a good risk reward trade, but the probability of success was perhaps quite low, but for whatever reason you thought you had a good edge on that, that would be what you'd do. And obviously the plus side with just buying call option, guys, is, or buying any option, is that your risk is limited to the price you've paid for the options, in which case 14 cents here or 6 cents in that one. If the USO, you get it completely wrong, it tanks through the floor, should I say, the call option is just worthless. All you've lost is the 14 cents per option contract traded. No big deal. Plus, the other plus side is that you have unlimited upside. If this thing should rip to $20, say, let's say it doubles for whatever reason, or most doubles, goes to $20, you're going to make $7 on that $13 call option, because the right to buy something at 13 that's currently 20 has got an intrinsic value of $17. So, you know, you're talking, $7 if it's 20. So you're talking $6, what are we, $6.86 profit, significant profit. And that would keep increasing as you went further up. So there's the ability to make, or the opportunity to make a lot of money, but you've got to get over that first hurdle of breaking even first. So maybe that's too much for you. Maybe you think, you know, that's a bit too bullish. You know, let's do something a little bit different. So what you could do is you could sell a put option. Now, selling a put option means taking the other side of the put option contract. Put option is the right to sell, the right but not the obligation to sell something. If we look at this example, sell USO at $11 at January the 18th. So the current price of that is 93 cents. That's at the money at the moment. There's a little bit of intrinsic value because we're at 12.73, but close enough. So that's right at the money at the moment. So what that mean to you? So if you sold the put options, you went short, or you sold it, these put options here, what would happen? Let's just do one at a time on this. If you sold the $11 put, you would receive 93 cents because the contract is being bought from you. So, and you're charging that guy 93 cents for it. He's buying the right but not the obligation to sell crude oil at $11 at that point in time in the future. Now, that's quite high. So that's reasonable to expect that, you know, it's quite volatile crude oil. The bonus or benefit to you is crude oil. If crude oil stays at $11, you pocket that full 93 cents. Assume we're at $11 now. Forget that we're slightly lower, but assume we're at $11. If it expires on January the 18th at $11, the contract expires worthless. You get to keep that full 93 cents. In actual fact, it can go all the way down to $10 and where are we? 7 cents before you start losing money. Because if you think about it, what's the value of the option contract? $10.07. The right to sell something at 11, it's $10.07, it's 93 cents. That's what they've paid the premium for the option anyway. So that's your break-even point. So you can see how it's slightly different, right? But don't forget, the difference when you're selling put is this. The maximum you can make is 93 cents. So if you're bullish on crude oil, the most you can make is 93 cents. This thing could rip to $20. You would still only make 93 cents because the put option expires worthless. You're on the sell side of the put option. The most you can go to is for you is to zero, and that's the most money you can make. which is still a reasonable amount of money, 93 cents. However, and also the probability of it doing it is perhaps higher when you're at the money as compared to something like this, for example. However, the flip side of that is that you are on the hook for potentially unlimited losses. Well, I say unlimited, crude oil can only go to zero, but it's still a hefty loss. So let's look at an example. Let's say this thing went down to $8, right? It went to $8, you got completely wrong, nowhere near right. It just completely slammed through the floor to $8. It was $8 at expiry. All of a sudden, that put option has got $3 worth of value because the right to sell something at 11 that's currently 8 has got $3 worth of value. You're gonna have to pay that out. Now, the guy or girl has paid 93 cents for the contract, so you have to pay out the difference, which will be $2.07. Which is still, you know, reasonable painful. And don't forget, if it went to $7, $6, $5, $4, you could be on the hook potentially for a hefty loss if that happened. Now, this is quite popular with traders when volatility is high because that's reasonably high priced. So you basically win if or crude oil just sits there, or you're basically winning from anywhere from $10.07 upwards, right? You might only make 1 cent if it's $10.08, but you get the point. You kind of don't have to be so right, and you're making money on a way wider scale. But at the potential, downside that if crude oil does pummel through the floor, you're on the hook for a lot of it. And the same with $10 put. You can see if we thought, well, $11 a little bit close to the mark, let's go further out. Maybe that's under a certain low or whatever. We could sell a put that's maybe under resistance. We think that's going to hold. That would be 49 cents. The same kind of rules apply, except this time we're only making 49 cents per contract. The buyer's only paying us 49 cents. That's all we're receiving. But of course, now the crude oil can sit anywhere between $10 and above, and we're going to make the full 49 cents, which gives us a little bit more room. And it can go further and further out, and obviously the price of this option contract is going to go lower and lower and lower, but the chance of it expiring worthless increases, but the payoff is there. One final thing, what we could do is we could buy a bull spread. So let's say we wanted to go in and we wanted to buy this, but we didn't really think it was going to completely rocket to the upside. We thought, you know what, it's probably going to go to kind of 14, 15 bucks, maybe 16. It's not going to go to 20. I don't need to pay the premium for that extra opportunity to make, jackpot money. I just think we're going to have a nice bullish run. So what you could do is reduce the cost of your option completely. If you're buying a call option here, a $14 call option, say at 6 cents, that's going to cost you 6 cents per contract. Now you might stick in whatever 10 grand's worth, however many that buys you, and that's what you're going to make. And if it goes to 12 cents and expires at 12 cents, you're going to make your money, double your money, etc. So you obviously, it depends on how much size you're willing to risk. But let's say you want to still risk that 10 grand on the trade. Now, wouldn't it be better if that whole trade only cost you 3 cents? Well, you could do that, because what you can do is you could buy your 14 call at 6 cents. So it costs you 0.06 cents minus, but you could sell the 15 call at 3 cents. Okay, and that will give you plus. So you basically take the other side of the deal. So you receive 3 cents. So the total net on this would just be 3 cents. Okay, so now you can afford to buy twice as many for your $10,000 as you could just buying the 14 call. Now, of course, the downside to this is anything above $15, you're not making any incremental money on. However, anything between 14 and 15, you're doing very nicely. The perfect scenario for you would be if it sat at $15. Well, in fact, it can go anywhere above $15, but you'd probably feel better if it just sat at $15, because at $15, you've made $1 on the $14 call option. So you've made plus 94 cents because you paid 6 for those. That's the difference between the dollar and the 6 cents. And the 15 calls become worthless. They expire completely worthless. So you make an extra actual 3 cents on that as well. 97 cents profit total. Pretty decent. Now you can see this is good if you've got a kind of moderate bullish thesis. If you really think this thing's going to rip to the upside, then it's no good for you, because obviously it goes to $20. What you make on the 14 call, you're going to lose on the 15 call because you're short that, and you have to pay that out. So that's something to consider. You've kind of got this sort of payoff graph, haven't you, like that. So it's kind of capped there as opposed to the pure call, which just goes straight up. Anyway, guys, those are option ideas for trading crude oil to the upside. I've said CL, that's a futures contract. In fact, you're better off trading USO, like I say, but those are some different ideas and strategies you could do, which you can kind of put your own numbers in and work out for yourself wherever we're trading at the moment when you're watching this video. Take care. Bye-bye.